We've read the headlines that the stock market is at or near its all-time high. So what does that mean for us? Should I get on board and go all in? Or is it actually time to be a little cautious? When it comes to our money, we want to be smart, right? So that's why Jeff Vogan is here to steer us in the right direction. Jeff, I think we need you now more than ever.
Maybe so. Well, I think you need me all the time. But
all the time.
Yes.
But I think because that information is out there and everyone goes, so that is the million-dollar question. Is this the time for me to jump in, or is this the time for me to be like, what should I be doing?
That's a great question. It's unfortunately the news has got us so fired up about the market and making new highs, you know, keeps making new highs. It almost sounds like the market's going straight up. Yet right. We're still not over 10% on the year. And in the long term, the stock market does kind of average in that range. We're talking 100 years or so. But over the last 20 or so years, because of the big market corrections that we've had, any 10-year period in the stock market really hasn't averaged more than about 6 or 7 at best. So people need to be cautious and really understand that we're having a good year now, but we are also at levels that we haven't seen before. And every time the earnings ratios get to where they are, every time the market gets kind of to a new high, we have to be cautious about what's going to happen in the future. One of the things that I remind my clients is, Warren Buffett, very rich guy, very successful person as far as an investor, recently stated that he's going more to cash and becoming a little bit more cautious. Well, if somebody that smart is doing that, maybe we ought to follow suit and be a little bit more cautious, especially if we're in the retirement stage, getting ready to retire or already retired and can't afford to lose money. In fact, Warren Buffett is the one that says the first rule of investing is don't lose money. And he has a second rule, and then that is don't forget the first rule. So, it's a kind of a don't lose money and don't lose money, especially if you can't afford to lose money.
Yeah.
And so that's really where we want to be cautious. We want to make sure that, if the market does have a corrective period, and we know that the last 2 market corrections were depressions. Yeah. Market went down 50% on the S&P 500, roughly 50% both times, just in the last 17 years. So we know it can happen again.
And I think that what we were saying, you see these numbers, you get a little excited, sure. And then we start thinking about things. But you're right, there's certain portions of your life where this, you need to be extra smart. We're talking about retirement, things like that. But are there maybe investment alternatives then?
Well, absolutely. And I don't think it's a bad time to consider taking money off the table. One thing I learned when I was a stockbroker in the old days was you never get hurt taking a profit. I mean, what's wrong with getting out of the market if you have had a good run, taking some of that money off the table and putting something where you won't lose money anymore? Yeah. If you're required, or if your retirement plan means to live off that investment income or take income from those investments, you can't afford to have those investments be reduced in value, especially to the tune of 50%, or even half of that would be a bad thing.
Yep.
It's kind of like having a coop full of chickens that lay eggs. You keep eating the eggs, but one day they don't lay eggs. Market correction, right? Right. And so you eat the chicken. Well, it's not going to lay eggs when when the time comes that you need more eggs.
That was a great analogy.
So it's kind of like eating your eggs when the market goes down if you're using the money. So very different strategy needs to be implemented when you're nearing retirement or in retirement than when you're just constantly putting money in, preparing for retirement, maybe in your 20s or 30s. Market corrections don't bother you. They shouldn't bother you. They should be exciting because you're going to get to buy stocks and mutual funds cheap. Yeah. But when you're retired, it's a whole different story.
Well, so is there, because I think the million-dollar question that everybody really wants to know is, I want to be safe. I don't want that huge risk, but I still want, if there's a bump, I still want to benefit from that. Is there that happy gray medium that we could be that person?
Well, there are. There actually, because of the way we're licensed in in multiple areas, not just the stock market, so to speak, or not just with securities. We also have insurance licenses, and there are products that are principal protected in the insurance market that do actually average pretty good returns. And if you consider, you can win by not losing. If you don't lose, you don't have to make as much on the upside as you would with the market if it's recovering from a big loss. And so if you can make nice and steady returns over time, you might be better off. And there are principal protected accounts. Many of them are called indexed or fixed indexed products. They could be annuities. They could also be fixed indexed. There's indexed universal life insurance, actually programs that have a floor where you can't lose money, yet you get a good piece of the upside. Now, those are insured products, and not everybody, I guess, is fond of the word insurance, yet it does have some pretty good track records if you consider where the market is and where the potential is with going in the future. But the other way to manage money is just through more of a tactical approach. And we use more of a tactical approach on our managed side. So with the securities, maybe we're in a certain allocation of stocks, bonds, and cash, we have managers that know when to pull the trigger and go to cash or know when to hedge. Whereas most mutual funds just say, ride it out. Yeah. It'll come back. Don't worry about it. The market always comes back, and it does. But if you're using that money, you can't afford to do it. So we also use a more of a tactical approach when it comes to the money management side. That just basically means, it really does mean hands-on. Tactical meaning hands-on, not,
right.
Tactical like, what, AK-47?
Yeah, I was going to say, big time tacticals, what we're talking about. Yeah. But this is exactly why I love when you come in, because we take something that we're hearing out on, the news and headlines, and it might get us a little bit excited, and you kind of break it all down for us. And I love that you and, of course, your team are going to be there for us. I'm going to remind them how to get a hold of you guys. If, of course, we have more questions, what should I do? What's going to make sure that I'm safe? We're not eating our eggs or the chicken or any of that.
I want to eat your chickens.
You don't want to eat the chicken. Jeff, thank you so much for coming in.
Well, thank you for having me.
Oh, absolutely. To learn more about Premier Retirement Planning and Wealth Management and actually their financial classes, please give them a call at 780-9059. You can also take a quiz online to see if you're ready for retirement by logging on to premret.com.